It's Sunday night, September 2008. The streets of New York are quiet, but inside the highest buildings in America, panic is spreading. Phones are ringing, markets are frozen, and the world's most powerful financial system is hours away from collapse. Behind closed doors in Washington, a small group of officials make a decision that will move trillions of dollars. Not through Congress, not through elections. By Monday morning, Wall Street will be saved, and millions of Americans will begin losing their homes, their jobs, and their savings. So here's the question most people never ask. Was the 2008 bailout really about saving the economy, or saving the system that caused the crash? To understand what happened, you have to understand the fear of 2008. For years, America's economy was running on debt, easy credit, cheap money, and the belief that housing prices could only go up. Banks handed out mortgages to almost anyone. Then they bundled those loans together and sold them as safe investments. By 2007, U.S. housing debt had exploded past $10 trillion. On the surface, everything looked stable. Underneath, the system was cracking. Think of it like a dam. Tiny cracks don't matter, until suddenly they do. And when homeowners stopped paying their mortgages, the cracks turned into fractures. Here's how the system actually worked. Banks didn't just lend money, they sold risk. A mortgage wasn't a loan anymore, it was a product. Thousands of mortgages were bundled together into something called mortgage-backed securities. Then those securities were sliced, rated, and sold worldwide. To protect against failure, banks used credit default swaps, basically insurance bets. But here's the problem. Anyone could buy that insurance, even if they didn't own the mortgage. So the same loan could be insured dozens of times, like insuring your neighbor's house and hoping it burns down. This created a financial web so complex that no one could see the full risk. Banks trusted ratings, investors trusted banks, and everyone trusted that the government would step in if things went wrong. That trust would soon be tested. September 15, 2008. Lehman Brothers collapses. A 158-year-old investment bank disappears overnight. Markets panic. Credit freezes. Companies can't borrow money to make payroll. Inside Washington, the message is clear. If another major bank fails, ATMs may stop working, businesses may shut down, the global economy may freeze. Treasury Secretary Henry Paulson and Federal Reserve Chair Ben Bernanke face an impossible choice. Let Wall Street fail, or rescue it with taxpayer money. That weekend, they choose rescue. Congress is rushed. Fear fills the room. Lawmakers are told the economy will collapse within days. The result is TARP, the Troubled Asset Relief Program. $700 billion approved in record time. But that number hides the real story. Behind the scenes, the Federal Reserve opens emergency lending programs, quietly committing over $16 trillion in loans and guarantees to banks and corporations. No press conference, no public vote, just a system saving itself. The bailout works. Banks survive. Markets recover. Stock prices rebound. But for ordinary Americans, the damage is permanent. More than 10 million families lose their homes. Unemployment doubles. Retirement savings are wiped out. Very few executives face consequences. No major Wall Street leader goes to prison. Instead, banks become bigger, more powerful, more essential. This moment changes capitalism. Risk is no longer punished. It's protected. Losses are socialized. Profits stay private. The message is clear. If you're small, you fail. If you're big enough, you're saved. And the cost shows up later, in inequality, in distrust, and in rising debt. The secret deal of 2008 wasn't just a rescue. It was a precedent. It told markets that collapse is temporary, and bailouts are permanent. Today, global debt is higher than ever. Banks are larger than they were in 2008, and the same emergency tools still exist. The system didn't break. It learned, and the next crisis won't announce itself either. So here's the question that matters now. If the system collapses again, do you think the rescue will look any different? Or will the same deal be made, behind the same closed doors? Backhand index pointing down, let me know what you think in the comments.